Hi everyone, welcome back to my channel. What is an inverted yield curve? An inverted yield curve occurs when the yield on short-term bonds, such as 2-year US Treasury bonds, is higher than the yield on long-term bonds, such as 10-year US Treasury bonds. As this video recorded, the 2-year T-bill rate is about 4.53% and the 10-year T-note rate is about 3.74%. This is an unusual situation, as investors typically expect higher yields on longer-term bonds to compensate for the increased risk of inflation and interest rate fluctuations over time. An inverted yield curve is often seen as a signal of an economic recession, as it suggests that investors are more concerned about the short-term economic outlook than the long-term outlook. So, why an inverted yield curve is considered a potential signal of an economic recession? In normal circumstances, the interest on a deposit you make to a bank will rise over time. The interest rate, however, is currently inverted. In other words, a 10-year deposit has a lower interest rate than a 2-year deposit. This is because the market expected a short-term interest rate decrease from the Federal. The short term could last between 1 and 2 years. Why does Fed will lower the interest rate in future? The possible reason might be the economy may have become worse, forcing the Fed to decrease interest rates in order to save it. An inverted yield curve suggests that investors are more concerned about the short-term economic outlook than the long-term outlook. When investors believe that economic growth and inflation will be lower in the future, they may demand higher yields on short-term bonds, as they are more worried about the immediate future. Conversely, they may demand lower yields on long-term bonds, as they are less worried about the long-term future. Some examples of inverted yield curves preceding economic recessions include the 2006 to 2007 inversion, which was followed by the 2008 to 2009 global financial crisis, and the 1990 to 1991 inversion, which preceded a mild recession in the United States. It's important to note that not every inverted yield curve leads to a recession, and other factors such as geopolitical events, monetary policy changes, and trade tensions can also impact the economy. If you have other opinions, let's comment below. Please help to like and subscribe.